Hello there, welcome to another live webinar with us from Phillip Nova. And today we have a very interesting topic that I think a lot of investors are wondering about right now. China's opportunities and where to invest now that China is reopening. All right. So to set the premise, the context for this webinar, we have twin pressures of inflation. Okay, twin pressures exerting force in China. You have inflation and recession, and this is hot on the heels of the current complex economic and geopolitical environment. China is facing a period of transition after decades of inexorable growth. Its late start in the reopening story has heightened the recent pace of acceleration, with domestic policies shaping industries and steering growth away from old areas into new ones. As the shift evolves, significant opportunities will emerge for the investors. And here we have in the studio is Ong Xun Xiang, ETF Product Specialist at Line Global Investors, to learn more about how we can optimize our China market exposure in our portfolio through ETFs. Just who is this gentleman in the studio? Let me tell you. He is an ETF product specialist with the product solutions team at Lion Global Investors, and he is responsible for driving ETF initiatives through product development, strategy, marketing, and this includes speaking at ETF investment events to equip investors like you and I with investment and industry knowledge. Prior to joining Lion Global Investors, Sun Xiang was a capital markets assistant vice president at ADDX, formerly iStocks, and that's a MAS licensed digital securities platform empowering investor access to private capital opportunities. And if you, before I hand the reins over to Sun Xiang, let me just do a quick poll. Can you hear me loud and clear? All right, quick poll. I've launched the poll. Let me know if you can hear. All right, great participation from the audience. 100% with a resounding yes. Thank you so much for your quick response. And now I leave you in the very good hands of our speaker, Sun Xiang. I hope you're all set to go. Yeah, you can walk us through your insights for today. Over to you, Sun Xiang.
Okay. Thank you, Sri, for inviting me here tonight. And good evening, everyone. Thank you for joining us tonight. I'm Xun Xiang from Lion Global Investors and can call me the ETF guy. So like many of you out here, I used to wonder how ETFs work. I first came across ETFs more than 10 years ago when I wanted to use it myself for my own portfolio. So ETFs are basically like Lego building blocks, which you can use to mix and match to build your own portfolio. They're also an extremely useful tool to help investors like you and me gain exposure to proper diversification that used to be exclusive to institutions. So I'm here today to share how you and I can use ETFs as building blocks to optimize China exposure in our own portfolios. And before talking about the specific building blocks, let me first introduce about LGI. So LGI is the asset management arm of OCBC Group, the longest established Singapore financial services group and Southeast Asia's second largest financial group by assets. Besides LGI, OCBC Group also consists of Great Eastern, which is our insurance arm, and Bank of Singapore, which is our private banking arm. So today we are one of Southeast Asia's largest and leading asset managers, managing 70 billion Sing dollars of assets. And we are relatively young in our ETF journey when we started our ETF journey back in 2017 by listing our first ETF, which was the S-REIT ETF, as you see here. And between 2020 to 2022, as you see here also, we listed 3 ETFs within 18 months. So within a short span of 5 years, we built our ETF business from 0 to 800 million today, together with support from investors like yourself here. And based on SGX data here, as you see, as of the end of April, our ETFs are also within the top 10 ETFs held by Singapore retail investors like you and me here. And if we zoom in further into CPFIS and SRS investors, Based on also SGX data, as you see here, our ETFs are also within the top 10 ETFs held by this group of investors. So after sharing about our ETF journey, I also want to share about China. After China's reopening in December 2022, it is a turnaround story that's being unfolded day by day. China is an extremely interesting market which holds immense potential, having both a strong foundation and of industrials together with high-profile companies that drive innovation. And today, China is the world's second largest economy and the world's second largest stock market. So armed with foundation and innovation, China is on track to surpass the US and become the world's largest economy by 2028. And when we talk about China, there are two levels to discuss about China. One is on the economy level, and another is about the leadership level. So at the economy level, China's GDP grew 4.5% year on year in Q1 this year, based on the latest data released back on the 18th of April. So this is faster than the 2.9% growth we've seen back in Q4 in 2022. And it also outperformed a lot of analyst estimates of 4% growth. So in fact, this was China's fastest growth since Q1 in 2022, when its economy grew by around 4.8%. And economists polled by Reuters recently also expect China's growth in 2023 to accelerate to 5.4% compared to 3% in 2022. So this year, China has also set a conservative growth target of around 5.0% this year. And PBOC, which is a central bank, have already reduced lenders' reserve requirement ratios for the first time in this year in March. And the government has since unveiled more fiscal stimulus to stimulate the economy. So unlike the previous two reserve requirement ratios cut in 2022 that happened and were announced during the pandemic and during economic slowdowns, the recent triple R cut from 11% to 10.75% was announced when the economy showed signs of recovery. And in April this year, China's retail sales also grew by more than 18% year on year, showing a significant rise in consumer confidence from its 2022 lows. So this is, in summary, China at its economy level. And on the next layer, when we talk about China, it will be on its leadership level. So China recently concluded its 2 sessions, which is called Liang Hui, earlier in March this year, officially electing President Xi Jinping for his 3rd term, and also appointing Li Qiang as its new premier. So within President Xi Jinping's inner circle, Premier Li has been regarded as the most pro-business politician. So Premier Li himself was born in Rui'an, Wenzhou City of Zhejiang Province, which is widely regarded as the birthplace of China's private economy. And throughout his long career, he has been known for 2 key economic achievements. First, he has driven the financial reform pilot project to reform private lending. And second, he has strongly supported the building of Tesla's Shanghai factory with a lightning Shanghai speed. So these events during and after the Liang Hui, also known as the 2 sessions, will shape China's broad direction in the next few years. And I've summarized them here into the 3 C's, as you see here. So the first C I want to talk about be about commitment. So commitment will be the foundation where China's recovery will be built upon. In the state-organized China Development Forum that happened earlier this year, in the 28th of March, Premier Li Qiang himself specifically assured Tim Cook and Ray Dalio that China will open up wider to the outside world. So other of the event attendees included P&G CEO John Mueller and also HSBC's CEO Noel Quinn. So this is a strong commitment by Premier Li to the top foreign business CEOs just in his first month as Premier. And after talking about commitment, the next C I want to talk about be about confidence, which is the fuel to keep China's engine running. So as you see here, Premier Li and Jack Ma have had a long relationship dating back even earlier than 2014. So back in 2014, when Premier Li himself was still governor of Zhejiang, he publicly said that there should be more Alibabas and more Jack Ma's. And when he was later party secretary of Jiangsu province in 2016-2017, he also frequently visited Jack Ma to encourage investments. So given all these, Jack Ma's homecoming after more than 1 year overseas is widely seen as a strong display of confidence in China's new government. And after talking about commitment and confidence, the last C will be about continuity, and particularly the continuity of policy to deliver economic growth. So to specifically ensure continuity of monetary policy, China reappointed Yi Gang as its central bank chief. And being US educated, Yi Gang has been known widely as a pro-market figure, capable of communicating on international platforms such as the G20 platform. And he's widely expected to continue policy stability, which is crucial to improve business confidence. So with all these said, what we now see is China's regulatory risk receding and the new government's renewed focus on stability. And with the global headwinds we see outside China today, there's a lot of volatility we can expect throughout the world. And in such volatile environments, it's actually crucial to stay diversified across sectors, while also invested in resilient industry leaders that have demonstrated better downside protection. And this is what the China Leaders ETF is about, a broad-based ETF made up of 80 China leaders that represent foundation and foster innovation. So now let's dive deeper into the China Leaders ETF. So this ETF has 3 key features. First, by tracking the Hang Seng Stock Connect China 80 Index, you gain access to the 80 largest Chinese companies listed on the Hong Kong Stock Exchange, Shenzhen Stock Exchange, and Shanghai Stock Exchange. Secondly, there's a 8% weightage cap on individual stocks and 40% weightage caps on individual sectors to ensure diversification across stocks and sectors. And thirdly, this is the first China-focused ETF that will make a distribution in Singapore. So the first dividend was already announced back in June last year and also paid in July in 2022. So all these are important features because large cap companies are usually mature companies that are less volatile, especially during rough markets. And especially when investors like you and me become more risk averse and move to quality assets. And a regular distribution also helps investors like you and me realize our profits periodically. And as you see here, the portfolio consists of constituents listed across Hong Kong, Shenzhen, and Shanghai. So on the right, what you see is 63% of the constituents are listed in China, while 37% of them are listed in Hong Kong. So having constituents listed across different jurisdictions are important to ensure geographical diversification. So since Hong Kong itself is an international market, there's higher correlation with global markets like the US. And in contrast, China is more domestic and self-sufficient. So it has lower correlation and is less affected by global events. And besides geographical diversification, the ETF is also well diversified across sectors with higher weightage in defensive sectors, like you see here in consumer staples. So this ETF has also exposure to the financial sector because Chinese banks deliver attractive and sustainable dividend yields of around 8%. So China's large state-owned banks have since been insulated from a lot of external shocks faced by banks in the developed markets because their revenue and balance sheets have mainly been domestic-centric and with the discipline to stay away from complex and risky products. So all these have helped Chinese banks and insurers rally between the end of April and early May this year, when investors reallocated their portfolios to more defensive sectors. And in fact, we have seen companies like Ping An Insurance posting strong Q1 2023 results, where it grew net profit by 49%. So all these sector diversification and greater weightage in defensive sectors have been crucial in smoothing the ETF's overall volatility or enhancing downside protection from riskier sectors. And if we look further here at the top 20 constituents, We also see many household names that are consistently industry leaders that demonstrate resilience and familiarity. For example, Ping An Insurance, you see here, which is Asia's largest insurer, ICBC, which is the world's largest bank, and Guizhou Maotai, which is the world's largest liquor maker. Since its listing, the China Leaders ETF has also outperformed other China-focused ETFs listed on the SGX. And as you see here, it has also closely tracked the Hang Seng Stock Connect China 80 Index. And since its recent low on the 31st of October, it has also grown 24% as of the end of April. And as I mentioned earlier, the ETF has also outperformed other China-focused ETFs listed on the SGX, such as the United SSE 50 China ETF and the Xtrackers MSCI China UCITS ETF. And specifically, if you read a 23rd April article on dollars and cents, the China Leaders ETF also outperformed the STI in Q1 this year. So such outperformance can be attributed to the index exclusion of American Depository Receipts, also known as ADRs. This has helped reduce the ETF's exposure to the foreign regulatory risks that have negatively affected US-listed Chinese companies when the US SEC potentially wanted to delist 174 companies that failed to comply with the Holding Foreign Companies Accountable Act. So by providing diversified exposure to 80 industry leaders listed in Hong Kong and China, the China Leaders ETF is less vulnerable to the foreign regulatory risks and better positioned to provide you the broad-based exposure to China. And now let me share about two key constituents among the top 10 constituents. So both are industry leaders and established and resilient industry leaders. One is the world's largest bank, as you see here, and another is the world's largest liquor maker. So the first constituent I want to talk about would be ICBC, which is the world's largest bank for the 10th consecutive year, with assets of around 5.5 trillion US dollars. And ICBC is also one of the ETF's top 10 constituents. So to set the context, right, the banking failures we've seen so far have mainly been limited to US and Europe because China's banking sector is more domestic and insulated from the global financial markets. And compared to Western international banks that have been more exposed to the troubled banks like SVB or even First Republic, Chinese banks, especially the big four Chinese banks, are state-owned banks, being required to have strong balance sheets and remain well capitalized. And since their main business activities are staying within China, they're less known internationally. Although the big four Chinese banks themselves are the world's biggest banks by assets. And despite the challenging economic environment, ICBC still managed to increase and grow net profit to 360 billion renminbi in FY 2022, being a 3.5% year-on-year growth. And between the 28th of April and the 8th of May, we saw Chinese banks rally at a record pace, unseen since 2015. And for ICBC alone, it rallied 12% when investors reallocated their portfolios towards safer and higher dividend yielding Chinese banks after the Labor Day holidays. And as of the end of Q1 this year, ICBC has also remained well capitalized, with common equity tier 1 ratio and the capital adequacy ratio remaining above 13% and 18%. And in fact, when comparing against average target prices set by analysts, there have been more than 20% upside identified for ICBC. The next constituent I will discuss about would be Guizhou Maotai, which is China's biggest liquor maker. So in 1949, Guizhou Maotai was designated as the official drink for China's founding ceremony. Since then, it has been the brand of choice for elites and considered a status symbol. So globally, it is the world's largest liquor maker by market cap, bigger than Diageo and Constellation brands. It is also larger than Coca-Cola and Pepsi, and being valued above 2 trillion yuan, which is around more than 300 billion US dollars. Guizhou Maotai is larger than Toyota, larger than Nike, and also larger than Disney. And surprisingly, it is also larger than ICBC, which is the world's largest bank that we discussed earlier. So imagine the scale of a liquor company for it to be larger than the world's largest bank. And after China's reopening, Guizhou Moutai has also kicked off 2023 with a strong start. It grew Q1 net profit by more than 20% year on year to around 21 billion yuan, beating its own 19% forecast. And in Q1 this year also, it also grew revenue by 20% to hit 39 billion renminbi. In Q1 this year, from its latest financials, the direct sales channel revenue also increased by around 64%, which accounts for around 46% of its total revenue, and demonstrating its optimized channel structure. So with the recent investment implemented to grow its capacity, more multi and also production capacity is expected to grow for Guizhou Multi. So because of all these positive factors we've seen when comparing against the average target price, analysts have also identified more than 20% upside for Guizhou Multi. So to summarize, the Lion OCBC Securities China Leaders ETF instantly offers you diversified exposure to the 80 China market giants, which include resilient leaders like ICBC and Guizhou Multi. And by excluding ADRs, the ETF is less vulnerable to foreign regulatory risk. It provides you broad-based exposure to China's recovery. With less than $2, you will be able to participate in the China growth story. So please log on to the Phillip Nova platform right now and ask everyone you know to search YYY for the Sing Dollar counter and YYR for the Renminbi counter to buy this ETF. So after understanding how the China Leaders ETF also provides you the broad-based exposure to China, some of you here might also prefer more concentrated sector exposure and also greater volatility. This will be where the Hang Seng Tech ETF comes in to provide you the specific exposure to Chinese tech giants. And now let me share how the Hang Seng Tech ETF can be the efficient building block to help you gain this exposure. So the Hang Seng Tech ETF basically has three key features to help you gain this efficient exposure to the Chinese tech sector. First, by tracking the Hang Seng Tech Index, you gain access to the 30 largest Chinese tech companies listed on Hong Kong. Second, an 8% weightage cap is applied on individual securities, so you avoid overexposure and build a diversified and well-rounded Chinese tech portfolio. And thirdly, the index has a unique IPO fast entry mechanism that enables newly listed tech companies to be included into the index without waiting for the next quarterly rebalance. And as you see here, the ETF is rebalanced quarterly and heavily focused on technology. And with support from investors like yourself, and also myself included, the ETF's AUM have recently reached 318 million as of the April last month. And the ETF also has 30 constituents, which are well-known industry giants capable of capturing the Chinese tech recovery. So China's tech giants have been banking on AI to ramp up their businesses, rolling out many new features for their existing services, and also innovative generative AI models. So Baidu, Alibaba, and also Tencent, all collectively known as BAT, have all expressed their belief of generative AI as a technological revolution. So specifically among BAT, Baidu's co-founder and CEO, Robin Li, specifically said that generative AI represents a tremendous opportunity, which is comparable to the introduction of the internet and also smartphones. And the tech giants' AI ambitions also reflect an escalating global arms race, where the US and also China and various countries seek to gain leadership over AI. And to put it simply for some of you here who might understand, this is in fact like a Game of Thrones playing out in Chinese tech and the world out there. And with this context in mind, the Chinese tech sector is favorably positioned for recovery. Since its inception in December 2020, as you see here, the ETF has went through various ups and downs. Since its recent low around October 2022, it has recovered 37% as of the end of April. And today, many of the factors behind the regulatory crackdown are receding, and we are seeing a lot of bright sparks for the Chinese tech sector ahead. And we are seeing bright sparks for the Chinese tech sector because of three key elements, also known as ADD. The first ingredient will be approvals. So in China, video games require regulatory approval before being published. And since Q4 last year, China has been easing its regulatory crackdown on its tech sector. Specifically for its video gaming sector, China's two largest online gaming companies, Tencent and NetEase, started receiving their game approvals back in November last year. And specifically, Tencent's Metal Slug Awakening was its first commercial gaming license that has been approved since April 2021. On the 20th of March, China also further approved 27 foreign games by Tencent, NetEase, and Bilibili. And on the 22nd of May, China further approved 86 domestic online games by Tencent and NetEase. So all these are bullish signals and signs we've seen in terms of the easing of regulatory crackdown. The second ingredient for China's bright sparks would be about development. So in his first press conference as Premier Li Qiang specifically highlighted the importance of technology and innovation in promoting a modern industry system. So Premier Li has since led by example. In his first month, there's been numerous positive business-friendly developments. So first, we have seen Jack Ma returning to China on 27th March after 1 year being overseas. And one day after Jack Ma's return, Alibaba announced the biggest revamp in its 24-year history, seeing it split into 6 business units, each with their own CEO, board of directors, and also the flexibility to seek their own listings. So since then, Alibaba has also been taking concrete steps and actions to unlock value. So in May, which is this month, it announced the full spin-off of its Cloud Intelligence Group through a stock dividend distribution, as Alibaba Cloud expects to complete its IPO in the next 12 months. Alibaba also announced to explore an IPO for Cainiao, which is its logistics arm, within the next 18 months, and also an IPO for its grocery chain, which is Freshippo, within the next 1 year. So all these are positive developments for the Chinese tech sector, because where in fact many other tech giants like JD.com are also taking similar steps to spin off their businesses. So this is the second ingredient, which is development. The third ingredient would be about demand. So in terms of demand, Hong Kong is the most invested offshore market for mainland China investors. And they have been active in investing in the two-approved Hong Kong-listed Hang Seng Tech ETF through the Southbound ETF Connect scheme. So these are expected to increase overall technical support for the Hang Seng Tech Index, increase demand for the ETF's constituents, creating a virtuous cycle for better expected performance. And now let me dive deeper into the two constituents of this ETF, which themselves cover two interesting trends in Chinese tech. One will be AI, and another is video sharing. So the first constituent I will talk about will be Baidu, which is China's largest online search engine with more than 70% market share. So Baidu was founded back in 2000 and recently completed its secondary listing on 23rd of March in 2021, raising $3.1 billion. So since its founding years in 2000, it has been a forward-looking growth company, which started investing in AI before many of its other competitors or players even thought about AI. So on the 16th of March this year, Baidu's founder, Robin Li, gave a demo of Ernie Bot, which is China's equivalent of ChatGPT, giving it a first mover advantage in generative AI at China. So within the first 2 hours, more than 30,000 corporates signed up to test earning bot. And all these launches generated a lot of growth momentum for Baidu, which translated into solid performance for Q1 this year. And particularly, Robin Lee mentioned that in Q1, Baidu Core developed a solid performance with year-on-year growth accelerating from previous quarters. So on the 16th of May this year also, Baidu released its Q1 results and demonstrated and announced its growth of revenue by 10% quarter on quarter to 31 billion renminbi. So these are important because it has beat analyst estimates of 30 billion renminbi. And when comparing against average target prices set by analysts, there's been more than 50% upside potential identified for Baidu. And in fact, after Baidu released about earning bot back on the 16th of March, there have been also other Chinese tech giants starting to ride on this AI momentum. On the 10th of April, Chinese AI firm, which is SenseTime, unveiled its AI-powered products like chatbot and image generator using its AI model, SenseNova. On the 11th of April, Alibaba also announced its own AI chatbot, which is Tongyi Qianwen, on the Alibaba Cloud event, with more than 200,000 enterprise customers applying for trial access. There are also plans to integrate Tongyi Qianwen into Alibaba Cloud and all the company's business applications. So the other tech giants also announcing that work on ChatGPT equivalents will be Tencent, which has announced Hunyuan AD, JD.com, which has announced ChatJD, and also NetEase, that has announced large language models to serve its education business. So the fun fact is that all these companies, which I mentioned earlier, are constituents of the Hang Seng Tech ETF. So instead of researching to find the exact stock that will win in this Chinese AI arms race, the Hang Seng Tech ETF already includes all the participants of this arms race. So you just have to invest in one ETF to cover the entire race. So this is what the Hang Seng Tech ETF is about: coverage of a bundle of Chinese tech giants that gives you diversified exposure to AI and also the big and important technology trends around the world. So after covering about the AI arms race, let's now move on together to the video sharing trend. So this next constituent will be Kuaishou. It is a popular video sharing app similar to TikTok and with 654 million active users every month as of Q1 this year. So this is around 47% of China's entire population. So live streaming and video sharing have been popular within China, and compared to TikTok and Douyin, Kuaishou is also more popular with older users that live outside China's tier 1 cities. So its initial popularity came from videos about China's rural life. And Kuaishou also relies more on e-commerce revenue than on advertising revenue compared to Douyin or also other platforms, and rewards content creators towards building a highly engaged user base. So in its recent Q1 earnings on the 22nd of May, Kuaishou announced its first ever positive adjusted net profit since its 2021 IPO. And in Q1 this year, Kuaishou also grew revenue by 19.7% to 25 billion renminbi and announced a new share buyback program to repurchase up to 4 billion Hong Kong dollars of shares in 2023. And when compared to a lot of average target prices set by analysts, there have been more than 60% upside potential that have been identified. So to summarize, the Lion OCBC Securities Hang Seng Tech ETF instantly offers you exposure to the top 30 Chinese tech giants. And with less than $1, you will be able to participate in the Chinese tech growth story. So similarly, please log on to your Phillip Nova platform right now and ask everyone you know to search HST for the Sing dollar counter and HSS for the US dollar counter to buy this ETF. So we have covered a lot today, and so it's important to summarize and then take action. So in terms of why, we spoke about the 3 C's of China: commitment, confidence, and continuity. This first month as Premier Li Qiang spoke about and committed to top foreign business CEOs like Kim Cook that China will open up wider to the outside world. Jack Ma's return to China after more than 1 year overseas, together with Alibaba's recent spin-off announcements, have provided strong credibility to Premier Li Qiang's reassurance. And a lot of growth-focused policies are expected to maintain continuity with the reappointment of Yi Gang as China's central bank chief. And in terms of how to build a diversified China portfolio, it's important to adopt a core satellite approach. So the core will be a foundation where you build your portfolio with established industry leaders and lower volatility. This is where the China Leaders ETF comes in, by providing you the broad-based exposure to 80 China market giants. And to provide you the additional returns through concentrated sector exposure and higher volatility is where the Hang Seng Tech ETF comes in, to provide the satellite allocation to generate the kicker and the additional returns. And with all these said, there will be short-term volatility happening as we see the recent banking crisis and also the Federal Reserve rate hikes exhibit their impact on the West. But if all of us, including you and me, look and think longer term, China is the world's second largest economy and is expected to overtake the US as the world's largest economy by 2028. All the recent crises that have been happening in the West, in fact, are expected to better position China, especially when China still grew GDP by 4.5% in Q1 this year and outperformed analyst estimates. So with all these volatility happening, it might in fact be a good entry point to start accumulating China exposure through ETFs now using the Phillip Nova platform and then dollar cost average. So I hope today's session have been useful to help you capture China's bright sparks. Thank you for being a great audience and for dialing in. I'll pass the time now back to Sri.
All right, thank you so
Back to
much
you.
for your sharing, Xun Xiang. Can you hear me loud and clear, Xun Xiang?
I can hear you.
Great, great. All right. I believe we have. Okay, this is a great time. It'll be a great time for you to ask any questions that you may have about what Xun Xiang shared about the China market. If you're keen to increase your exposure, this will be a great time for you to ask questions so we can pick them up and I can fill them to Xun Xiang to give us his insights. KST, you asked, you wanted to learn more about ETFs being discussed. The two ETFs that we discussed today are featured on your screen right now, so you should be able to have a great idea on the ETFs that we have discussed today. Danny is asking, in Danny is asking, Xun Xiang, if you have invested in Lion OCBC Securities HS-Tech at 55% and Lion OCBC Securities China Leaders ETF at 25%. Since IPO have been in the red, when do you see the market will turn around, or what are some of the bright sparks which you shared during the webinar? Maybe this is a good time to reiterate the bright sparks for the China market. Xun Xiang, would you be able to walk us through?
Thank you, Sri, for the question. Okay, in terms of what you mentioned about investing since the start of IPO and when we think it will be turning around. I mean, to be upfront, we don't have a crystal ball. We cannot tell the future. But what we can say is we're seeing a lot of bright sparks and also bullish signals, positive signals that have been appearing. So for example, we have mentioned about the 3 C's, which is about commitment and also catalyze and also confidence and also continuity that's presented by the Chinese government. We have seen, especially let me go to the slide specifically. about commitment, confidence, and also continuity that have been happening. So we have understood that China's recently there have been a lot of bullish signals happening. This economy has already outperformed analyst estimates. And in terms of commitment, new premier, which China's new premier, already committed that China will open up wider to the top foreign business CEOs. In terms of confidence, there have been a lot of bullish signals after Jack Ma's return. We've seen Alibaba announcing spin-off of at least 3 of its businesses, and we are expected to see more with all these listings happening, more value within the Chinese tech sector being unlocked. And while at the same time on the policy front, policies are still expected to maintain continuity. So this will be building a more stable foundation for the Chinese tech sector to further exhibit its various spin-offs and also unlock greater value within the sector.
All right, thank you so much, Xun Xiang. We have some more questions from the members of the audience. Dave is asking, is the China renminbi hedge against the SGD when we buy a China ETF?
Okay, in terms of whether there's currency hedging being done, okay, the thing is we don't always do currency hedging, but at the but because there are transaction costs involved, but our fund managers are allowed to perform currency hedging as and when required. So to answer your question, yes, we have the flexibility to perform currency hedging when required.
Right, next question is from Molly Crew. He's asking, can you comment on the yuan's recent depreciation? Does China slow its production in expectation of potential recession in the US and EU and slower demand and leading to slower demand for China goods?
Sorry, I don't see the question being flashed. To comment on the China's slow its production, blah blah blah. Okay, due to slower demand of. So actually, okay, in terms of this question about the yuan's recent depreciation and also so it's okay to put into perspective. I mean the reason might not be why the yuan is depreciating. It could be more on why the US dollar has been appreciating, while at the same time on the yuan currency side there's remain relatively stable, and the USD has been mainly appreciating because of the various rate hikes. We have seen at least 10 rate hikes since last year that happened to raise interest rates up to 5% this year. So all these have helped the US dollar to strengthen to a certain level, and because of that, comparatively, we look at the yuan. It shows that the yuan has been depreciating, and whether it will slow its production expectation of recession in the US and EU. The thing about China's economy is that it's not fully dependent on the global economy because itself there's a large domestic economy already. So regardless of when all these exchange rates comes in play when there's China is exporting the goods it produces. But if it's just manufacturing for its domestic economy, the impact might not be as big. So because of that, China's consumer confidence continues growing, which it has grown and demonstrated its growth of around 18% quarter on quarter in Q1 already. So all these are expected to be positive signals for China going forward.
All right, Xun Xiang, another question on a potential slower growth and the geopolitical tensions that we're having. So what are your views on what other headwinds do you see for the China market?
Okay, in terms of the headwinds we see in terms of that's happening. Okay, I mean definitely the ongoing tensions we see between US and China definitely these are some of the headwinds that that are happening for China, that there are potential headwinds. But if we look into on the broader picture, right, I mean, both are both are giant economies. Both are giant economies. There are in the end still need to grow their economies together, because both are, I mean, right now there have been a lot of tensions we see, for example, on the some of the semiconductor bans and all these. But on the larger front, both parties and countries also understand the important benefits of working together and being able to cooperate and also uh, work together towards being responsible giants for the entire global economy. So I mean, but there might be minor frictions here and there occasionally, but the longer term, both parties understand that in the long run, it's important to work together and instead of threatening or even creating frictions for each other's economy. So I mean, what I would say is some of these headwinds, they are rather short-term headwinds. And also at the same time, at the West, what we see is that there have been also a lot of banking crises that have been unfolding, especially in the West. So all these actually position China better because it's seen as a more, I would say, stable environment, because on, for example, the Chinese bank front, they have remained well capitalized compared to many of the other Western banks that have been exposed to complex risky products. And for Chinese banks, they also deliver higher dividend and also attractive dividend yields for a lot of investors. They are many of the world's biggest banks involved. So because of that, they are more they provide greater confidence, especially among the mainland China investors themselves.
Xun Xiang, are you able to see the rest of the question?
I cannot see the questions actually. So oh,
I can read them out for you, actually. All right. The next question is on our China leaders ETF. What stock exchanges does the China leaders ETF have constituents in?
okay, in terms of the constituents, the ETF for China leaders, it has constituents listed across Hong Kong Stock Exchange, Shanghai Stock Exchange, and Shenzhen Stock Exchange. Yeah.
Okay. Okay. So next one is, would you be able to summarize the distribution list for China leaders ETF policy?
So in terms of the ETFs distribution policy, is an annual distribution. The dividend rate and record date will be announced by end of June. So it's coming in just within the next 30 days and will be paid by end July.
All right, on to the next question. What is the index's distribution yield for China leaders ETF?
For the index distribution yield, in terms of the latest 12-month yield, what we've noticed is at around 3.6% for the China leaders ETF.
Okay. What are the stock tickers for the Hang Seng Tech and the China leaders ETFs that you want to that you think that the audience should keep an eye on?
So for the Hang Seng Tech ETF, the stock tickers are HSD for the Sing dollar counter and HSS for the US dollar counter. And for China leaders ETF, stock tickers are YYY for the Sing dollar counter and YYR for the renminbi counter.
All right, Sun Qiang, I've snapped some of the other questions that you are unable to see on the questions panel. Would you be able to address it? Okay, no worries. Let me. I think you still have issues looking at it. Can I read them out to you instead? All right. The next question is we have a question on what kind of currencies can you trade both ETFs in?
Okay, in terms of the currencies, for Hang Seng Tech ETF, can be traded in Sing dollar and US dollar. For the China Leaders ETF, it will be Sing dollar and renminbi.
The is the management fee included as part of the expense ratio?
So, to the short question will be the short answer will be yes. Management fees are part of the total expense ratio.
Okay, so what are the key differences between the Lion OCBC Securities China Leaders ETF and the Hang Seng Tech ETF?
So, in terms of this question, okay, there are a few key differences. So the first difference will be in terms of the number of constituents. Maybe I can scroll down to the number of constituents. So the Hang Seng Tech ETF has 30 constituents, while the China Leaders ETF has 80 constituents. In terms of the base currency, the China Leaders ETF's base currency is in renminbi, while the Hang Seng Tech ETF's base currency is in Hong Kong dollar. In terms of trading currencies, I covered earlier. And in terms of the constituent coverage, the Hang Seng Tech ETF's constituents are all listed within Hong Kong. But for the China Leaders ETF, the constituents are listed across Hong Kong Stock Exchange, Shenzhen Stock Exchange, and Shanghai Stock Exchange. And in terms of the distribution policy, the China Leaders ETF pays dividends every year. And in terms of there's also another bit about diversification, which is special and unique to the China Leaders ETF, which is about the sector weightage cap of 40% for sector weightage for the China Leaders ETF.
Okay, this is quite interesting. Why is Alibaba not in the Hang Seng Stock Connect China 80 index?
So thanks, Ree. In terms of the question, it is not in the index because Alibaba is not eligible for Stock Connect because it is a ADR that's listed in the US.
I see, I see. So, in that case, right, what I noticed, I remember seeing Tencent earlier. So, what are some of the overlap stocks between the Hang Seng Stock Connect China 80 index and the Hang Seng Tech index? Are there some overlaps?
Yes, there are indeed overlaps. So in terms of the overlap constituents between these two, okay, Tencent is one of them, like you correctly mentioned. There are other few which one of them will be Meituan. There's also Xiaomi. Another constituent is Haier Smart Home. Maybe it's easier if I scroll here. Haier Smart Home and Kuaishou, Li Auto, and also JD Health. So there are a total of roughly 7 constituents that have overlap, and the aggregate rates are around 15% and 45% in the China Leaders ETF and Hang Seng Tech ETF respectively.
All right. So in the meantime, I think while we're waiting for our last question, let me just share an ongoing promotion that we have with Phillip Nova. It's our 40th anniversary right now, and as part of our 40th anniversary, we're giving away welcome gifts to all new customers to Phillip Nova. And I know May is coming to a close. May we are giving away Apple AirPods. Come June, we are giving away digital subscriptions like Netflix, Spotify, Disney Plus, as well as iTunes gift cards. So you get prizes, welcome gifts, worth up to $250 when you open an account during the promotional period this year as part of our 40th anniversary. That's not all. When you are a Phillip Nova customer, you get to stand a chance to take part in 4 other lucky draws for the rest of the year. And you can stand to win exciting prizes like iPad Pro, as well as a trip on a cruise. and a fine dining, spa, and even travel tickets as well. So this year it's all about giving back to our customers. This is your great chance to be part of both of these promotions, and you can simply sign up, scan the QR code to learn more. Okay, so just to sum up, our 40th anniversary giveaway, May's exclusive gift was the Apple AirPods. Come June, we are giving away digital subscriptions worth up to $250 for Spotify, Netflix, Disney Plus, as well as iTunes. All right, so we'll send these details if you are interested and haven't had time to scan the QR code in our follow-up email. So do look out for it tomorrow. Meanwhile, thank you so much for all the wonderful questions. We really enjoyed receiving them. And thank you so much, Xun Xiang, for your valuable insights in today's webinar.
Thank you, Sri. And I have to say this promotion is a very attractive promotion. So even I'm tempted myself. So guys, please sign up.
Thank you. Thank you, Xun Xiang. Thank you for that endorsement. There you have it, members of the audience. It is truly an exciting promotion. It's our 40th anniversary, and it's time to give back to the community and our customers. So this is your chance to receive your gift and stand a chance to win a trip on a cruise. All right. So thank you for all your questions. If you have more questions, you can send them in the survey form at the end of the webinar. We'll send them over to Xun Xiang tomorrow, so he can give you some short answers to them, and we'll add them in our follow-up email as well. All right, thank you for being a wonderful audience. Just so you know, Xun Xiang will be coming back in another webinar in June. We'll add the details in our follow-up email tomorrow as well, so you can sign up and ask Xun Xiang all the questions that you have about ETFs as well. All right, thank you so much, Xun Xiang.
Thank you, Sri, and thank you everyone for joining. Have a great evening ahead. Goodbye.
All right, till our next live webinar, please take care and all the best for your trading for the rest of the week. Goodbye.